Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hey, Tony.
Now, Evan, today jobs numbers out. Let's talk about those, what they mean or what they show, and importantly, what they mean for the economy.
There's lots you can look at it, positively, negatively, depending on also your views in terms of how you want to work it. Numbers were slightly disappointing. So we saw the 18th consecutive month of job gains. So there is a positive to it. However, it came in at around about 4.9 thousand jobs added, give or take. And that's because full-time actually really fell away in the month of March. So about 19,900 full-time jobs were lost, but around about 26,000 part-time jobs were created, which is interesting, which has slightly broken the trend. If you still look over the year, full-time is well and truly outstripping part-time. So there is positives, and this is what I mean. So we know that employment is stronger. It is. Unemployment fell today, which is a good thing. Participation, this is the interesting one. Participation is actually, today it eased off, but it's at a record. So the last time, you have to go back to December 2010. So the participation rate is about 65.7%, something you shouldn't see considering we're an aging population and we've had a slowdown in the mining boom, which was, back in those years was really powering that number. So pros and cons are certainly there. There is still a lot of what they call slack, and the capacity in the employment market is still quite high. If you look at what they call underemployment and underutilization, they're really high. So they're sitting about sort of 15% for underutilization, which is basically the unemployment rate plus the underutilization, the underemployment. Underemployment is people that are employed but want to work more. So they're either working 4 days rather than 5, or 3 rather than 4, such and such.
That's this gig economy that we talk a lot about.
Correct, and it's the part-time, but it's not just that. It is actually like, there are full-time jobs now that are only 4 days, or they're only working sort of 35 hours rather than working 38 hours a week. Little things like that. So the issue with it, and this is where the negativeness comes about, unfortunately, is the ability to draw out that slack in the economy to therefore put pressure on wages looks further away from the official data. Now, the interesting thing is last week we talked about NAB business confidence and the NAB conditions. Businesses are cashed up. We know that. Businesses are quite heavily on the profitable side. Their employment metrics are actually through the roof. So there may be a movement to it, but the data today suggests that the official numbers are slightly stagnant. And that's why, again, the draw through is, do we see the slack being picked up in 2018? Probably not as fast as we did. Does that mean that wages will grow faster? No, because there isn't any upward pressure on the ability for employers to find employees. Pros, cons.
Yeah. And then I wanted to ask a couple of things. So firstly, does it show any particular sectors that are under pressure in terms of jobs?
It does, and they're ones that you'd expect. So if you look, mining is still very much under pressure. So we've had a really big boom in them in 2017. Probably that's down quite heavily to a lot of the material going on over in Western Australia. Northwest Shelf is now being completed. There's been big engineering projects in Queensland that have also now been completed, and they've fallen away. It probably explains why Western Australia has actually got the highest level of unemployment in the country at 6.9% on a seasonality basis. Queensland's not that far away, it's about 6.2. So that would probably explain it. There's been an interesting slowdown in retail. Again, not unsurprising.
Not surprising, yeah.
The one that really caught my attention, it's not a huge movement, but it catches my attention because of what it's been doing, that's health. Health is one of the only sectors in the country that is just almost linearly moving up. The expenditure on it, both publicly and private, is ginormous. It explains a whole heap of our employment. It's on the verge over the next decade of being the largest employer in the country. It's slowed down, and that is also interesting. There are some people that are inferring meanings about why. The interesting one that I've been looking at is actually the gender differences. So over the last 3 years, women have completely outstripped men in full-time employment, which is a real positive thing. They hit a record in participation since records ever begun, which is also a really positive thing, but they collapsed in March. About 18,000 of those full-time jobs lost were women. I don't understand how that can be that dramatic, and only 1,000 were men. But it would likely come down to health, considering that it tends to be a female-dominated industry, and that may explain it. But it is positive to see such a big upswing, and the chart that I've got to show you today is that closing of the gap in participation between men and women, basically since records began. So we are looking at bang on 40 years ago, so February 1978 till today. It is good to see that closing down, but there was some slight mysteries in the March numbers.
Yeah, maybe that'll come out in due course, in terms of what's causing that, where the losses are on that front. The other side of it is, I think it's important to sort of bring this back to, things like interest rates, what these jobs numbers could mean in terms of the Reserve Bank, and we'll get to the Reserve Bank statement as well. But would seem that there's no pressure on the Reserve Bank.
No pressure at all. It gets back to what we're sort of talking about inside there, is that slack in the economy means that upward pressure we need wages to do that filters into inflation, because that's the mandate, right? That's the mandate we're looking for, is inflation at the bank moves towards 2 to 3%, more likely towards 2.5%, to give them the ability to actually shift on rates, and it's just not coming through. So that's the way to look at it from the employment numbers. You'd also look at it from the point of view that, is there going to be a change in household consumption? Probably not. Although people's employment status is becoming more assured and people believe they can actually find work, the fact that you're not seeing an increase in your hours worked or the amount of wages that you're collecting per annum, it means people are still fairly conservative with spending, particularly on the discretionary side. And that's also what you can see, not just in the numbers today, but across the board. So the RBA is out. That's a clear given, and we've known that for a while. Next part of your question was the minutes at the start of the week. They're still upbeat, and they should be. Things are pretty rosy, but they are starting to put some caveats in there. And what I mean by that is, the one that everybody's highlighting is that growth is on track to be its best since 2011. So this is still when the whole mining movement was still happening in this country. So it looks like coming at about 3% for 2018. However, if you go back 18 months ago, they were saying it was going to be between 3 and 4%. If you went back 12 months ago, they were sitting at 3.5. The last statement of monetary policy said 3.25. They're moving away. So they're saying that it's going to be above the potential rate, and their potential rate is 2.75%. So there's every expectation now that growth is going to narrow down to about 2.8 to 3%, which is below trend. And again, answering your question, does that give them the kudos to raise rates? Probably not.
So no real surprises, I suppose, in terms of what the Reserve Bank was saying. The message hasn't really changed.
No, message hasn't changed at all, and it's all on there. I mean, if you want to pick up anything different, it's more people like Guy Debelle, who's been quite strong in the last 2 weeks about inflation as the mandate for banks, and then also around whether or not rates are the tools that they should be using, because as I've explained it before, it's a sledgehammer. It's a blanket tool across everything. So although they might want to slow the housing market, raising rates goes across everything, personal lending, corporate lending, blah, blah, blah. So it's quite a blanket tool, and what he was alluding to was macro-prudential, and we can see that in the housing market. Some people will argue against that, but he has a point, which is that you can't do, and again, the term is, you can't do fine art with a sledgehammer. So you can't tinker or tighten parts of the economy that need to be moved with a really, really blanket tool like interest rates. That, I think, is the more interesting thing from the RBA at the moment.
And it'll be obviously interesting. We're getting closer to the budget. We're going to talk more about that over the next couple of weeks and beyond, probably. But in terms of tinkering around with the economic tools to fine-tune the economy,
yes,
we'll be
waiting
in with bated breath anyway to see what comes out.
This week's term was Santa Claus, obviously, for Scott Morrison, and whether or not you believe that or not, 3 things I would probably point out leading into it that are already starting to becoming a big theme. Looks like for the first time in half a decade that there will be income tax cuts. That looks pretty certain. It will add about 1.7%, give or take, to the disposable income line. So that's an interesting one. Certainly will help the economy. Infrastructure looks like it could be a big winner. There is growing signs that they will spend a huge amount of money on infrastructure. We are a year away from an election. And the third thing that is certainly starting to filter out that is also quite interesting is tightening the rules around things like super. I think they have to, because of what's been coming in from the other side of with the opposition around things like imputation credits. And I know that we've spoken, not just with us, but also with other guests around what the Labor Party's imputation credit changes are happening. But it looks like they will probably put a line under the sand about how they touch super, and that super will not be changed under their tenureship, which is interesting to put through a budget. But they're the three things to watch. Yeah, the brackets that come into the taxation, infrastructure, and treatment of super.
As the government would say, it's all about jobs and growth.
Jobs and growth. And they've got the jobs, they've got the growth. It's just not that consistent.
Yeah. We'll leave it there for today, Evan.
Thanks, Tony.
Join us again for the Economic View.